So good people, hello traders, my name is Flaren. I'm here with another video right now. So for the new beginners, welcome to my YouTube channel. If you have not subscribed to my channel, I think you're losing it all. Okay, this is the right time to actually take your time and learn, gain the concept very much clearly. You should get the concept very clearly and let's get it in. So today marks actually midweek, and the thing is that midweek as always. So for the week, we usually follow something we call market accumulation, manipulation, and distribution. So manipulation occurs in the midweek. Okay. So right now, I need to actually do a market liquidity mapping right now. And what we need to be understanding, we need to be understanding the key features of market ac price action. So for the price action to be actually created, we must have something we call uptrends. Okay. The market creates something we call an uptrend. So that's it's actually formed by higher highs and higher lows. Okay, okay, or market is actually on a bullish trend. If we analyze what I'm talking about here, bullish trend. That's actually for the beginners. Okay, now for the downtrend, it's actually created by formation of lower highs and lower lows. Okay, that's bearish trend. Okay, bearish trend. We'll actually be talking about candlestick anatomy because I know many beginners have not yet understood how the candlestick anatomy is created. So that's actually price action. If you understand the price action very much clearly, you can actually be getting the best of yourself because price action will always give you the market price. Okay. So for us here, we're actually going to see how the market is actually flowing and we need to analyze the market very much clearly. Okay. So as you can see here, there was a creation of high highs and high lows leading to an uptrend on the market. Okay, this is right. Okay, you can see it created higher highs. High, okay, so the market actually went higher, and then it did a market structure shift, changed character. The sellers went the position of the markets. Okay, so the market went downwards, and it actually consolidated. You can see how the market actually went here. It consolidated. Some support here. We're actually doing a liquidity mapping. Okay, don't forget it's consolidated. When the market is actually consolidated, it's actually running within a specific range. So you can see here, there was no one who was in control of the market, this particular zone. It consolidated, right? You can see this. This is something called a fake breakout. So this zone here, it's actually called fake breakout. And that's actually one of the most dangerous places we need to be actually working out as traders, because fake breakouts are actually created by institutions to actually stop out traders who are actually on grid. Okay, so this is a fake breakout. So we're actually doing a top-down analysis. We are on our 4-hour time frame, and we need actually to switch up our lower time frame, and then go to our. We just go to our 15 minutes time frame, 1 hour time frame. Okay, see how it was. See, So you can see here that we were actually saying the market was actually consolidated on this particular zone. So the market was consolidating, get consolidation. We're actually doing something called liquidity mapping, okay? Get consolidation, okay? Okay. And then now we can see here the market was actually consolidating. It did a fake breakout. This is a fake breakout. So for example, if we could have actually did short position, this particular zone here, targeted as certain profitable, take profit on this zone, did a stop loss on this particular zone. That means actually the institutions will do as much as possible to actually look for this particular stop loss. So this is called stop loss hunt. Okay, stop loss hunts. So this actually, since you're not alone who is actually in the market, institutions will look for your stop loss and they'll hunt it down. So that's actually called stop loss hunts, or generally we usually call it a liquidity hunt. Okay, this is liquidity, liquidity. I know people ask me about this particular terminologies, but we should be understanding more and more better because this is ICT trades and there are some terminologies that you should be familiar with. I'm going to be talking time and all over again. Okay, so you can see here the market was actually consolidating. Then I told you guys you should avoid fake breakouts. Okay, avoid fake breakouts. Avoid fake. Okay, should have breakout actually meant to actually put you down, slow your trades, and actually hunt down your stop losses. So you can see here, what do you do? Do you do rather? You actually wait for market actually to come onto your position. So if you actually, so you could have actually, for example, if the market was actually on this particular zone here, you could have waited for this. If you could see them, for example, there's something we call the power of the institutional reference points. Okay, power of the institutional reference points can actually be seen. Institutional reference points are actually these ones, order blocks, breaker blocks, liquidity voids, fair value gaps. I'm going to be talking about them all over and all over again. So for the order blocks, and order blocks actually the last candlestick to print before a huge move. Okay. So for example, I'll show you an order block right now here. I want to show you an order here. It's actually the okay before a huge move. Now for example, this one you can see here. This one is an order block. Okay. That's actually the That's actually one of the institutional reference points I should be understanding about. It's actually one of the candlestick that has actually printed before a huge move. Okay. The other one is actually a fair value gap. Fair value gap I've actually been talking about market imbalance. I've actually been talking about it. This is a fair value gap. Okay. You see this particular week of the previous. You see there must be a middle candlestick that is actually longer than the other two. This one it has created so this particular week, this this week here and this week here, they don't meet. So this space here that's actually been created, it's actually a fair value gap. And the market will do as much as possible to actually revisit. Okay. So for this particular zone here, this is a fair value gap. Okay. Now I was talking about now how the market was actually flowing and how you can actually enter trade after the market consolidation. So you could have seen a breakout, right? But you could wait for the market to actually come again. Okay. Enter for example, let me show you here. There's some enter zones. Because what you can do here, let us go to a 30 minutes time frame, 50 minutes time frame to have very clear get get view. Okay. Now now I was talking about being stopped. Okay. Because the market actually went outside the range. So this is a fair value gap. Okay. So most traders, you should listen to me here. Make sure you enter zones that actually because you're an ICT trader. Make sure you enter zones that actually control actually by the. For example, if you can enter this particular zone here for fair value gap, you could have been on profits. Okay, because the market has revisited it very clearly. It shows you blueprints of it. Okay, this is where market orders are actually exchanged, and you can do as much as possible to actually. Can do as much as possible to actually. I'm sorry, guys. Yeah, trying to use this. Yeah, the market will always do as much as possible to actually retest back on fair value gaps, and orders are actually exchanged on these gaps. They're very much important to actually revisit. So if you could have entered on that zone after that particular gap, on that particular level, you could have incurred profits. See, guys, you can see here, this spot here. Let me show you the fair value gap. So what do you do next? You wait it to retouch and then do a market structure shift. Then go highs. Okay, go long position. Okay, stop loss. You actually set it below previous. Okay, then you target this profit. Okay, very important, very important. The other one is actually here. You wait it's you wait it's survival gap. You wait it to touch the spot. Wait for market structure shift. Okay, we actually call it market structure shift. Then get structure shift. Okay, get actually what shows. That's a fair value gap. I'm talking about entering trades on fair value gaps. Market fluctuates, then gold short. Very easy. But now it depends of how you actually um, target profit. Okay, stop loss you should actually create below the resistance line here. Okay, and target. Okay, you can target 1:3. It all depends on how your targeting your target profit is. So that's all for today. Make sure you stay tuned. My name is Florent.